Everyone wants a piece of the AI boom, so they chase GPUs, piling their portfolios with the hottest names. When Nvidia sneezes, the whole market catches a cold. But here's the catch, the real profits don't come from owning what everyone else is buying. They come from owning what everyone else depends on, but hardly anyone is paying attention to. There's a company that doesn't make chips, doesn't build data centers, and doesn't sell AI models. But without it, none of that works. No chips get designed, no hardware ships, no AI runs. Right now, it's flying under the radar with 80% recurring revenue, billion-dollar backlogs, and margins software companies dream about. The crazy part? Most investors know the name but don't grasp how critical it actually is. Let's be clear, this company doesn't make chips. It doesn't manufacture silicon, run foundries, or ship hardware. What it does is own the workflows every major chip maker on the planet depends on, and they've been doing it for over 30 years. They didn't just jump on a trend, they built the track. This company develops the software that designs chips before they ever go into production. The Electronic Design Automation, EDA, stack is what turns chip architecture into reality. It's how Nvidia engineers design H100 GPUs, how Apple prototypes silicon, and how Google builds their TPUs. That company? Cadence, ticker symbol, CDNS. It's right at the center of it all. Cadence isn't a speculative AI play. It's an S&P 500 company with 80% recurring revenue and client relationships that most businesses would kill for. But here's the wild part, most investors still don't understand what they actually do. In one quarter, Cadence added over 50 new customers to their Cerebrus AI platform. Cerebrus has already powered more than 1,000 chip tape-outs, meaning real, physical silicon designed using their AI. Their tools are so critical that removing them would cost customers millions and delay products by months. This isn't hype. This isn't potential. This is real infrastructure. While the market drools over GPU headlines, Cadence gets paid every time one of those GPUs is built, no matter who builds it. The takeaway? Cadence isn't a chip maker. It's the bottleneck every chip maker must pass through. In the AI arms race, being the bottleneck is the most profitable spot you can hold. Financially, Cadence prints numbers like a software company, but with semiconductor growth. It doesn't behave like a typical chip stock or a pure software stock. It's both, and neither. You're looking at a company with the financial engine of a SaaS business, riding the tailwinds of a semiconductor cycle with a product so sticky it's nearly irreplaceable. Let's look at the numbers. This isn't theory, it's Q1 results. Gross margin was 88.4%. Operating margin, on a non-GAAP basis, was 41.7%. Free cash flow hit $464 million last quarter alone. Revenue grew 17% year-over-year, accelerating. Earnings per share jumped 34% year-over-year. These aren't startup multiples, they're industry-leading execution metrics, and they're getting better every quarter. Most chip makers would kill for these margins. Most software companies would kill for this backlog. Here's what makes it even better, Cadence doesn't just sell one-time licenses. They lock in multi-year contracts with global chip makers, foundries, and hyperscalers. This isn't discretionary spending, it's infrastructure spending. That's why 80% of their revenue is recurring, and their gross retention rate is through the roof. This business can grow 10 to 15% annually without needing the broader market to cooperate. It's not cyclical noise, it's contractual cash flow. And just last quarter, they bought back $350 million worth of shares. They know the strength of what they've built. They also know Wall Street hasn't fully caught on yet. These are elite financials in a misunderstood corner of tech. This isn't hype, it's a cash flow machine, and it's only getting started. So here's the real question, is this business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, revenue, and cash flow? Absolutely. Is the product becoming harder to compete with? Without a doubt. In Q1, Cadence posted $1.01 billion in revenue, a 17% increase year-over-year. Free cash flow was up 43%, hitting $464 million. Their total backlog hit an all-time high at $6.44 billion, and recurring revenue remains at 80%. They even raised full-year guidance across the board. They're not hoping AI demand shows up, they're booking it in advance. They're not chasing customers, they're closing multi-year renewals with Fortune 100 chip makers because this software is embedded deep in billion-dollar product schedules. What you're seeing is operating leverage in action. Every quarter, the business throws off more cash without bloating headcount. Margins are scaling, not just holding steady. And while others complain about macro uncertainty, Cadence is stacking growth from hardware, IP, systems, and AI workflows, all firing. The takeaway: if you're still wondering if this is a good company, you're asking the wrong question. The real question is whether the stock price reflects how fast this business is compounding. Based on how the market is behaving, it doesn't. Now, every great business has its blind spots. Here's Cadence's China. Last year, 11% of their revenue came from China. This year, management is modeling that number to 0, not down, 0. That's a big deal. Despite planning to lose that billion-dollar revenue segment, Cadence still raised full-year guidance. Revenue is up, margins are up, earnings are up, all while writing off a huge part of their business. That's not normal, that's real strength. But don't let that distract you, this is a geopolitical time bomb. It's not about product failure or competition. It's about US export restrictions tightening, and Cadence's core software being labeled critical national security infrastructure. That puts them right in the crosshairs of every future sanction. If Washington tightens ADA exports, if Beijing retaliates, or if major customers shift development away from US tools to avoid scrutiny, that 11% doesn't just disappear, it sends shockwaves through the market. So yes, the business is strong, the core cash flow engine is intact. But this risk could drag the stock down regardless of fundamentals. If you're not factoring that in, you're not investing, you're gambling. That's why it's important to see the full picture, not just the upside, but the risks too. Is Cadence a long-term buy? Let's break it down. The bull case: this is one of the most efficient business models in tech. Most investors are still sleeping on it. We're talking 80% recurring revenue, gross margins near 90%, operating margins around 40%. This isn't hype, it's a machine. They have long-term contracts with Nvidia, Apple, AMD, Intel. Their software is so critical it's classified as national security infrastructure. That's not hype, that's US export policy. Cadence doesn't need to win the AI race, they just need everyone else to keep building chips. Revenue is projected to grow from $4.3 billion today to $6.1 billion by 2027. EPS is forecasted to climb from $5.97 in 2024 to $10.55 by 2029. That's without any heroics, just steady execution. And here's the kicker: as AI chip designs get more complex, Cadence becomes even more essential because they own the tools that scale. Now the bear case: two real risks, China and valuation. China was 11% of revenue last year. Management is modeling that down to 0. They're preparing for it, but geopolitics don't care about guidance. If headlines flare up, the stock could react violently. Valuation is another concern. You're paying 77 times earnings. That's expensive. If growth slows or margins slip, the multiple could compress fast. Bottom line, this isn't a trade. It's a business with compounding earnings, a bulletproof model, and a geopolitical shadow hanging over the stock. If you want fast momentum, look elsewhere. But if you want to own the tools AI depends on, and can handle the noise, this is a long-term asset worth watching closely. Now, about the elephant in the room: the stock's been flat for the last year. Actually, it's down about 8.3%. Why buy a stock that hasn't moved in 12 months? Because you're thinking like an investor. The market got distracted, but the business didn't. Cadence has stacked stronger numbers every quarter: revenue, EPS, cash flow, backlog, all up. Meanwhile, the stock has basically done nothing. That disconnect? That's opportunity. You're not chasing a parabolic run. You're stepping into strength that hasn't been priced in yet. Technically, $295 is solid support, tested and respected multiple times. Every bounce from there has led to upside. $326 is resistance. A close above that could trigger momentum flooding back in. So what am I doing? I'm not going all in. I'm not swinging for the fences. I'm building a position slowly, only on pullbacks or strong setups. The fundamentals are clear. The technicals are tight. The setup is clean. And the real question remains, is this business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, revenue, and cash flow? Absolutely. Is the product becoming harder to compete with? You bet. That's the kind of bet I want to make, not noise, not hype. Real fundamentals. Final thought, if you're not making money, that's on you. You have two choices: keep watching headlines and reacting, or get serious, execute with clarity, and focus on real